Before geopolitical tensions escalated, the primary mortgage market was sitting in a manageable pocket. Rates were comfortably below the 6% threshold. Today, those same rates have spiked to 6.62%. This jump happened despite a highly publicized executive directive from the Trump administration. The plan was to expand the mortgage-backed securities portfolios of government-sponsored enterprises, or GSEs, by a massive $200 billion. When that order came down, a significant portion of the market assumed this capital injection would function like traditional quantitative easing. The expectation was that a $200 billion buy-in would force rates on a downward trajectory. But the data shows the opposite. As the $200 billion intervention commenced, the primary mortgage rate climbed right through the downward pressure of those massive buys. The expected yield compression never materialized. Instead, the spread environment widened. Fannie Mae and Freddie Mac have adopted a measured, selective approach to these purchases, which challenges the assumption that they would act as aggressive rate suppressors. Macroeconomic volatility now dictates the direction of the secondary market, regardless of these specific interventions. Treating this $200 billion expansion as a primary tool to set consumer rates misjudges both the internal mechanics of these agencies and the scale of the global macro forces pushing against them. This chart shows this dynamic playing out. On March 22nd, reports confirmed GSEs placing sizable orders to purchase mortgage-backed securities. Within 2 days, the secondary market reacted. Spreads tightened by 18 basis points. That movement successfully dropped primary mortgage rates by 15 basis points. That downward momentum was strictly an announcement effect. It was driven by initial algorithm and trader reactions to the news, not by a structural shift in capital flow. Spreads reversed course, erasing the initial 18 basis point gain. Then it blew past the pre-announcement baseline of 100 basis points, establishing a new, higher ceiling at 125 basis points. Because the market instantly priced in the absolute maximum of that $200 billion cap, the intervention immediately lost its capacity to exert continuous downward pressure on yields. To understand why $200 billion in buying power stalled out, we have to look at the mechanics of the intervention itself. When the market anticipates aggressive rate compression, it is usually looking at the operational model of the Federal Reserve. Historically, the Fed intentionally purchases assets at inflated prices. Their explicit goal is to crush yields and drive rates down. Fannie Mae and Freddie Mac are using a different playbook. Operating like risk-averse asset managers, the GSEs initially focused on conventional securities tied to primary rates, but they quickly executed a strategic pivot. Instead of issuing cash window pools, they retained premium pools, which offered the most attractive value in a volatile market. Because the agencies prioritize relative portfolio value over intentional price inflation, their operational methodology limits their ability to meaningfully compress primary rates. To fully understand the failure of this intervention, we have to look past the secondary spread and examine the bedrock of all mortgage pricing, the 10-year Treasury yield. This chart illustrates how a 6.62% mortgage rate is built. It consists of a massive baseline dictated by the 10-year Treasury yield, topped by a thinner layer representing the MBS spread. A $200 billion GSE program can only ever compress that top layer, but powerful macroeconomic forces are expanding that foundational Treasury layer. The first is stubborn, persistent domestic inflation. The second is volatility and heavy sell-offs within the tech sector. The final force is geopolitical risk. The recent conflict involving Iran has become a driver of Treasury volatility. When geopolitical shocks and inflation force the Treasury baseline upward, it eclipses the incremental spread compression achieved by the GSEs. To see what that Treasury volatility looks like in practice, you have to look at the front lines of capital markets, the lender pricing desk. This timeline tracks the real-world consequences on retail lenders. Earlier this month, desks at firms like AD Mortgage were forced into defensive rate repricing 2 to 3 times a day to keep up. Yet recently, that severe intraday volatility has vanished. The stabilization occurred because the GSEs are not operating on a fixed, systematic buy schedule. They are actively watching the tape. Their strategy is reactive. When rates spike and liquidity dries up in the secondary market, Fannie and Freddie step in immediately to put a floor under the market, giving pricing desks room to breathe. The $200 billion program acts as a critical intraday shock absorber. It prevents the primary market from seizing up during geopolitical panics, even if it remains unable to dictate the broader price of housing. The policy intent behind this GSE program is clear. Officials want to support housing affordability. But industry participants caution that prolonged, artificial intervention in the secondary market always carries systemic side effects. The most severe consequence right now is known as the lock-in effect. Keeping mortgage rates low for too long disrupts the housing market's natural life cycle. Homeowners sitting on sub-4% rates refuse to sell their properties. This psychological gridlock chokes off physical housing inventory, which inflates home prices further. The GSEs are successfully injecting enough liquidity to prevent a total market freeze, but they are powerless against the scale of global inflation and war. The $200 billion expansion serves as a liquidity buffer. This capital injection cannot force down primary rates while broader economic forces move in the opposite direction. Until the macroeconomic fires of inflation and geopolitical risk finally burn out, attempting to influence mortgage rates from the top down will only deepen the structural distortions in the American housing market.